Hi, I'm Michael Ruger. I'm the managing partner at Greenbush Financial Group. Today we're going to be talking about required minimum distributions, otherwise known as RMDs. Now, the IRS has a rule that says once you hit a certain age, you are required to start taking small amounts out of your various retirement accounts, which are your IRAs, 401ks, 403bs, each year, and those distributions are taxable to you. Now, there were recently some big changes to these rules when Congress passed the Secure Act in December of 2019. So prior to 2020, the start date for RMDs used to be age 70 and a half. Now, going forward 2020 plus, the start date for RMDs is now age 72. So Congress pushed that date out by another year and a half. But there are some special circumstances for people that are kind of caught in between these dates. If you turned age 70 and a half prior to December 31st, 2019, then you are still subject to the old rules. So even though you might be 71 in 2020, you still have to take your RMDs because you turned 70 and a half prior to December 1st, 2019. So how is your RMD calculated each year? And the IRS actually makes this very simple. They've got a table called the Uniform Lifetime Table, and I'll show you what it looks like here. So you're gonna see one column for your age and one column that has something called a distribution period. So all you do is you find your age in the chart, you go over the right, you circle the number that's in the distribution period column. Now you take your 12/31 balance from the previous year and you divide that by that number you found in the distribution period column, and then that is your RMD for the year. Now the way the math works out as of right now under the current life expectancy tables, if you turn 72 this year, you have to take out about 3.9% of your account balance in the form of an RMD. So the way that kind of the math works out is for every 100,000 you have in your retirement accounts, you got to take about 3,900 out in that first year, and then that amount will increase a little bit potentially each year because that divisor keeps getting smaller, as you'll see in that distribution period column. So there are some very important deadlines that you need to be aware of with these required minimum distributions. Now, in most years, you have to have your RMDs distributed from your retirement accounts by December 31st. The IRS doesn't care if you take that evenly throughout the year or if you take it in one lump sum at the beginning or the end of the year. They just kind of say, hey, look, if your RMD for the year is $5,000, that money has to have left all of your retirement accounts by 12/31. Now, there's a special exception for the first year you're required to take an RMD. In that first year, so let's say I'm turning 72 this year, I have the option to delay my first RMD up till April 1st of the following year. And there's a tax strategy embedded in this, in that I may, in my first RMD, since I'm required to take this money out and it's taxable income to me, I might want to push that into the next tax year, because a lot of people, if you've had wages or you sold a piece of property in that first year, you don't want more taxable income in that year. You would prefer to push that into the next year where you have less taxable income and those distributions are taxed at a lower rate. So instead of taking it before 12/31 my first year, I might want to take it on January 5th. So it pushes it into the next tax year. Now, what you have to be very aware of is if you do delay your first RMD to the next year, in year 2, you are going to be required to take 2 RMDs. The one by April 1st for the previous year, and then your second for that next calendar year by 12/31. So just know you're going to have to double up in those years. And the reason why it's very important to be aware of these deadlines is if you don't distribute enough from your IRAs or retirement accounts to satisfy these RMDs, the IRS hits you with a 50% excise tax. So of the money you should have taken out, the IRS is going to take 50% of that. So in my $5,000 RMD example, if I forgot to do my RMD or I missed the deadline, the IRS is going to take $2,500. Not good. Now, with this rule change, there were some people that were grandfathered in, unfortunately, under the old 70 and a half rule, which was the prior RMD requirement. So if you turn age 70 and a half prior to 12/31 of 2019, you are still required to start your RMDs at that old 70.5 age. You do not get to take advantage of the 72, because we had some clients call saying, hey, it turned 70.5 in 2019. Oh, no, I don't have to take one for this year, next year, because now the rule is 72. No, they actually have to keep taking those RMDs, because if your date of birth was before July 1st, 1949, you are subject to the old 70.5 rule. If your date of birth was on or after July 1st, 1949, you are subject to the 72 rule going forward for your RMD start date. So the Secure Act also made some small changes to a popular IRA distribution option called a Qualified Charitable Distribution. Now, prior to the passing of the Secure Act, the way this option worked is if you were RMD age eligible, which meant age 70.5, in that year, if you were required to take an RMD, you could direct that money from your IRA to a non-for-profit or charity or a church, and if you did that and you never came in contact with the money, then you didn't have to pay tax on it. So not only were you able to support your charity, but you didn't pay tax on the distributions that you were required to take. And also, this has become a lot more popular because with the passage of tax reform, since charitable contributions, people used to just deduct them on their tax return, they're now itemized deductions. Most people don't itemize anymore, so they weren't even able to capture the deduction anymore. So by being RMD eligible and directing it to those charities, you were kind of backdoor capturing the deduction that you were losing under the new tax rules. Now, where the Secure Act changed this a little bit is, since they bumped the RMD age out to 72, the question was, well, now do we have to wait until 72 to be able to make these qualified charitable distributions? And thankfully, the answer was no. Even though they bumped the age out to 72, they said people in the calendar year that are age 70.5 are still eligible to make those QDCs in that tax year. Now, if you decide to go the route of these qualified charitable distributions, you have to be very careful. There's a lot of rules as far as exactly how it has to make it from your IRA to the charity. And because we see a lot of people make mistakes, I actually attached a link in the description of the video for an article specifically on that. So if you are intending to potentially do these type of distributions from your RMDs, make sure you read the article. Now, the Secure Act did also make some additional changes that are going to impact these QDCs, which prior to the Secure Act, so before 2020, as soon as you turn age 70.5, you are no longer allowed to contribute to traditional IRAs. The Secure Act changed that. So years 2020 going forward, if you have any type of earned income, you are going to be allowed to contribute to a traditional IRA up to the limits and then deduct that on your tax return. Now, where this influences the qualified charitable distributions is they say if you're making contributions to those IRAs past 70.5, when you go to make your first qualified charitable distribution, we're going to back those contributions after age 70.5 out of what you would have been able to avoid tax on, and you're going to pay tax on that amount. So just quick example. So from 71, 72, 73, I made $6,000 contributions each year. So I contributed a full $18,000 to my IRA during those 3 years and took the deduction. Let's say now I've got a $30,000 required minimum distribution that I need to take out of my IRA, and I want to put that all to charity. If I do that, all the money, the $30,000 goes to charity, but they look back and say, wait, you gave $18,000 to your IRAs, you contributed over the last 3 years, you will have to pay tax on the $18,000 of that RMD, even though it went to charity. The $12,000 is the only piece that you're going to get, the non-taxable piece for that qualified charitable distribution. So just be careful. Some of these new Secure Act rules introduce some complexity for people that are going to be contributing past age 70.5. I hope this was helpful. If you have any questions, please feel free to reach out to us at moneysmartboard.com. Thank you.